Welcome to this explainer on UBS Group AG. Today, we're unpacking a really fascinating financial paradox. We're going to look at how a massive global bank can post record earnings, execute an incredibly complex merger, and watch its stock price absolutely skyrocket, all while facing what could only be described as an existential regulatory threat. If you've got money in European markets, if you follow global finance, or honestly, if you just care about the stability of the worldwide banking system, this is a story you absolutely need to follow. All right, let's dive right in.
To truly understand the gravity of this story, we first have to look at the sheer momentum behind the bank. Since late March of 2026, UBS stock has been on an absolute tear. We are talking about a surge of nearly 50% in a remarkably short window of time. I mean, a 50% surge pushes their total market capitalization to a staggering $162 billion. On paper, it looks like a picture of pure, unadulterated success, right? It's the kind of momentum that usually signals a company with a completely clear runway ahead of it. But there is a massive catch to this success story.
And that brings us to the central question of today's explainer. Despite this epic 50% rally, why is Wall Street's hottest European bank trading at such a steep discount compared to its American rivals? It's kind of like having the fastest, most beautifully engineered car on the track, but everyone in the grandstands is somehow betting against you winning the race. When you take a look under the hood of that valuation, it becomes pretty clear that something deeply concerning is making the broader market hesitate.
That hesitation is obvious when we stack UBS against its American rivals. Right now, UBS is trading at 1.8 times its tangible book value. Now, to be completely fair, that's actually their highest multiple since 2010. They are undeniably climbing. But then you look at Morgan Stanley, and they are towering over them, trading at a massive 3.7 times forward tangible book value. In fact, American rivals across the board are trading at an average of 2.5 times forward tangible book value. The gap between UBS and the American giants is just staggering. So what exactly is acting as a lead weight on the UBS valuation?
Section 1. The $20 billion regulatory bombshell.
Here's the dramatic collapse of Credit Suisse back in 2023. The Swiss government decided that the country's banking landscape needed a serious overhaul to protect the broader economy from ever facing that kind of systemic risk again. Their proposed draft bill would force UBS to fully capitalize its foreign subsidiaries at 100%, which is a massive jump from the current 60% requirement. The price tag for this new regulatory demand? A cool $20 billion in additional capital. Let that sink in for a second. $20 billion of capital just locked up. That is money that a bank absolutely cannot use to grow its business, lend to clients, or return to shareholders through dividends. The bank's chairman, Colm Kelleher, has been extremely vocal about this, warning that these extreme rules could seriously damage the entire Swiss financial center.
And the government didn't just ask for any $20 billion. They originally demanded it in Common Equity Tier 1, or CET1 capital. To put this in perspective, think of CET1 like emergency cash stuffed deep inside a highly secure vault that the bank is absolutely forbidden to touch under normal circumstances. It's the purest, safest money a bank has to protect against a crash. But for the bank itself, it's the most expensive and restrictive form of capital to hold. Forcing a bank to lock away $20 billion of this specific ultra-premium capital essentially paralyzes a massive chunk of their balance sheet. It completely chokes off their ability to aggressively compete on the global stage. Now, to ease this immense burden, Swiss lawmakers are currently locked in a fierce debate over a potential political compromise. Instead of forcing UBS to lock up 100% of that requirement in that ultra-expensive CET1 vault, they might allow a split. The compromise would potentially allow UBS to use cheaper additional Tier 1, or AT1 bonds, to cover up to 20% of that massive requirement. AT1 bonds are essentially a form of contingent convertible debt. They're just far less punishing on a bank's day-to-day balance sheet than CET1. This compromise would provide a critical, much-needed pressure release valve for the bank's capital strategy.
But even with that 20% AT1 compromise, well, the financial pain is still very real. RBC Capital ran the numbers on this scenario, and they estimate that UBS's returns would still drop by roughly 2 full percentage points. That drop would push UBS's return on tangible equity below 15%. Remember Morgan Stanley and the American banks we discussed a minute ago? Those titans are currently cruising at returns of 20% or more. This regulatory move, even in its compromised form, threatens to act as a permanent speed limit on UBS's competitive profitability, keeping them functionally tethered while their U.S. competitors sprint ahead.
Let's shift gears. Section 2, Q2 2026 Earnings and Operational Triumph.
So, with a staggering $20 billion threat looming, why exactly has the stock surged 50%? Simple. because the underlying business is absolutely crushing it. On July 29, 2026, UBS reported a massive net profit of $2.8 billion. Earnings per share came in at a robust 87 cents, and that revenue line, $13.3 billion, actually beat overall market estimates by a very solid 4.5%. To signal just how confident the leadership team is in this operational strength, the bank even announced a brand new $3 billion share buyback program. Operationally, the engine isn't just humming, it is roaring.
Underlying pre-tax profit didn't just grow, it surged by a massive 45% year-over-year, hitting an incredible $3.9 billion. And the growth they're seeing is absolutely everywhere across their divisions. Equity trading revenue, that surged by 53%. Wealth management transactional income grew by 22%. The investment bank's pre-tax profit more than doubled on the back of truly record-breaking revenues. We are looking at a core business that is simply firing on all cylinders, generating massive amounts of cash despite the dark regulatory clouds gathering on the horizon.
Section 3. The Credit Suisse integration.
A massive driver of those phenomenal earnings stems directly from the execution of the Credit Suisse merger. Merging two complex, deeply entrenched global banking giants is notoriously difficult and fraught with systemic risk. Yet UBS is executing this with incredible precision. As of mid-2026, they've already realized a staggering $12.6 billion in cumulative gross cost savings from the integration. Their ultimate target was $13.5 billion by the end of 2026, which means they have successfully achieved over 90% of their goal well ahead of schedule.
And they haven't just cut costs, they've surgically streamlined the entire combined operation. They've aggressively unplugged and decommissioned over 90% of legacy IT applications, completely removing massive layers of technological redundancy. The highly complex migration of Swiss client data, that's now completely finished. On the personnel side, they've reduced the combined workforce by about 28% since the 2022 baseline, which equates to roughly 17,500 positions eliminated. Now, it is certainly worth noting that they still expect about $750 million in final integration expenses in the second half of 2026, but the heaviest lifting of this historic, monumentally complex merger appears to be firmly in the rearview mirror.
Section 4. Wall Street's verdict and rational exuberance.
So we have a bank perfectly executing a historic merger and literally printing money, all while staring down a home government that actively wants to lock up a massive chunk of its capital. How is the smart money weighing this extreme tension? Well, the big players are overwhelmingly bullish. Bank of America has slapped a confident buy rating on it with a $63 price target. JP Morgan believes the current valuation discount is excessive and also maintains a solid buy. Even the more conservative institutional targets like Goldman Sachs' hold rating still sit comfortably at $58. The overall consensus across the board is a very clear buy at $55.03. That implies the market sees even further upside from where we are sitting today.
So how do we make sense of all this aggressive optimism in the face of such a massive threat? Actually, a recent Reuters Breaking Views commentary brilliantly called the UBS valuation surge a case of rational exuberance. This isn't just blind hope. Investors are actively running the math. They are rationally betting that the Swiss government will ultimately blink and offer a manageable compromise rather than fully cripple their own premier financial center with a full $20 billion hit. Furthermore, because the underlying business is generating cash so rapidly, even if UBS does take a mild capital hit, they're going to be eroding those returns from a much higher baseline of profitability.
Section 5. Key risks and the unresolved climax.
To be a focused learner, we must always weigh the downside. There are 4 primary risks on the table right now. First and foremost are those Swiss regulatory capital requirements we've been heavily discussing. Second, while it's gone perfectly so far, there is always residual execution risk in finishing out the final tail of the Credit Suisse merger. Third is macro uncertainty. CEO Sergio Armati specifically pointed to incredibly volatile energy prices and shifting geopolitical developments that are currently clouding the global inflation and interest rate outlook. And fourth, U.S. competitive pressure. Remember that massive valuation gap from earlier? If Swiss regulators choose to heavily handicap UBS, American giants like Morgan Stanley are perfectly positioned, well-capitalized, and entirely ready to eat their lunch on the global stage.
This entire regulatory saga is currently hurtling toward a very specific, highly anticipated climax. Back on August 11th, the Swiss Parliamentary Committee completely deadlocked. They fundamentally couldn't agree on exactly how harsh these new capital requirements should actually be. That deadlock makes August 31st the most critical date on the financial calendar for this story. That is exactly when the committee reconvenes to desperately try and hammer out a final compromise before pushing for a full September upper house vote. August 31st is the moment of truth where we finally find out just how big this regulatory bomb is actually going to be.
So I will leave you with this final critical thought to consider. We've comprehensively unpacked the spectacular operational earnings, the masterful, historically precise merger execution, and the undeniable stock momentum pushing the bank upward. But we've also squarely faced the staggering $20 billion threat currently looming inside the halls of the Swiss parliament. Are investors ultimately right to price in a gentle, politically negotiated compromise? Or, in the rush to celebrate a generational banking triumph, is the market dangerously underestimating the blast radius of a $20 billion regulatory bomb? Keep your eyes locked on August 31st. Thank you for joining me for this explainer, and keep learning.